depreciation upon what? Revaluation. So I think in our case, what we need to do here is basically to compute what? We need to compute the accumulated what? Or actually, we need to compute the excess depreciation here. The excess depreciation. The excess depreciation. Do we compute it at this point, or we compute it as we prepare the PP account? Yes, let's compute that as we prepare the PP account. Remember, I've said we need to prepare the PP account and the accumulated depreciation account. So that, yes, let's first of all skip that. We will basically come back to that equal to note number 1. So let's first of all we move to note number 3. And in note number 3, we are told during the year which ended 31st of October 2025, a motor vehicle which had a cost of 2 million and accumulated depreciation of 800,000 was disposed of for a cash proceeds of 1080. The gain or loss on disposal was included within the distribution. I think this one is quite simple because we are told there was a motor vehicle which was disposed. Remember, I said that anytime the company disposes or sells an asset, we need to compute the gain or the loss on disposal. How do we compute this particular gain or loss on disposal? We said we take the sales proceeds minus the net book value, or basically the carrying amount, of which we say that this one is equal to the cost minus the accumulated what? Depreciation. So in our case, we are told the motor vehicle, which was disposed as per note number 3, was disposed, or actually we are told its cost was 2 million and accumulated depreciation of 200,000. So the cost was 2 million, and you have said we are working with all our figures in thousands of shillings. The accumulated depreciation was 800,000. So meaning that the net book value of the carrying amount, this one was 12. And then you're told it was disposed for 1020. That is the proceed. So meaning that here it was sold at an amount which was less than the carrying amount. In other terms, if you take this minus that will give us a negative. That one will give us a negative, which automatically is the loss on disposal. So what is the loss on disposal here? Is it 180? The loss on disposal? The loss on disposal, is it 180? Is it 180? Is it 180? 180? 180? Yes, 180. So remember, when preparing the statement of cash flows, there are 2 items you're going to consider here. Number 1, this one, the loss will have to be added to, will be added back to the profit before interest and tax. And number 2, when computing the cash flow from investing activities, we said we take into account the sales profit. How much amount was received from the sale of that asset? So we are done with that. So, but also remember this information which we have in note 3. We will also use this when preparing the PP account. Let's move to note number 4. And you're told the company acquired new investment in equity instruments for a cash and designated them at fair value through other comprehensive income. Remember, in the topic of financial instruments, we talked about financial asset. Financial asset, we said it is investment in equity instrument. It is investment in shares. So we are told during the current year, the company acquired new equity, or actually the company acquired new investment in equity shares. In other terms, the company acquired additional investment in what? In shares, and actually designated that, or actually classified those particular investment as at fair value through other comprehensive income. Now, where do we have information about that? Where do we have information about the financial asset? Remember, this was the abbreviation for those financial asset at fair value through other comprehensive income. And remember, we said that these are equity instruments which are acquired by the company, and the company has an intention of holding them on a continuing basis. The company has an intention of holding this equity instrument for a long period of time. That's why we say these ones are basically classified as non-current asset. If you go back to the balance sheet of this company, specifically at the non-current asset, you'll be able to see something called equity or investment in equity instrument. Now, that investment in equity instrument basically is what is a financial asset at fair value through other comprehensive income. Investment in shares, the company intends to hold these shares for a long period of time. Now, here you can see at the start of the year, the value for this equity instrument was basically 0, but basically it has increased all the way to 12,100. That's why we are told in note number 4 here, this investment in equity instrument was acquired during the current year. So in this case, you can see therefore, this has an increase over 12,100. But remember what we said, this particular investment in equity instrument, they're recorded in the statement of financial position at their fair value. So they must be remeasured to their fair value at the end of each year. Now, if you can be able to recall in the income statement, can you go back to the income statement? Can you go back to the income statement? In the income statement down there, where we have the profit for the year, we have other comprehensive incomes. Now, these other comprehensive incomes, basically, we have two items. We have the gain on property revaluation, and then we have fair value gain on equity instrument. So basically, this investment in equity instrument, which was acquired by the company during the current year, their fair value increased with 600,000. So the company bought some shares during the current year, but when the year was coming to an end, their market value had increased with 500. Now, in our case, what we want to do here, we want to determine how much cost was paid by the company in acquiring these shares. So automatically to be able to determine the cost, because whatever you're given here, this is the fair value. And this fair value of this equity instrument, this one includes the gain. Include that gain. Can you be able to know how much amount was paid by the company? For example, you bought some shares during the current year. We don't know the amount which you paid, but we know that at the end of the year, these shares will be having a value of 50,000. But equally, we are told that the value for these shares has increased with 10,000. Now, in this case, can we be able to determine the cost you paid in acquiring these shares? Because that's what we need to know here. So we know that the market value of the shares at the end of the year was 50,000. The market value increased with 10,000, but we don't know the cost you paid. Can you be able to determine the cost which was paid here? Then, can you be able to determine the cost which was paid here in acquiring these shares? I hope you're understanding this, whatever I'm explaining here. We are saying you bought some shares during the current year, the shares which are trading in the securities exchange market. Now, we don't know the cost you paid, but we know the market value of those shares at the end of the day is 50,000. And we are told since you bought those shares, the market value has increased with 10,000. Can you be able to determine the cost which was paid in acquiring those shares? Can you be able to tell the amount? Can you be able to determine the cost you paid in acquiring those shares? Yes, it's automatically very, very simple, this one. It's automatically very simple. Dagote, can you be able to determine the cost? Yes, the cost is automatically the market price minus the increase in the fair value. So you bought them at 40,000. You bought them at 40,000. And if you add this increase in the market price, you get the fair value at the end of the year. The same case here. The shares which were bought by the company, we are not given their cost, and that's what we want to know, how much cash was paid, but you are given their fair value at the end. But we know that this fair value has increased with 600. Has increased with 600 as per the income statement. So meaning that we can be able to know, to determine the cash which was paid by the company. So the cash which was paid by the company in acquiring this equity, this investment in equity instrument will be this minus that. So how much is that? It is 11 what? It is 11,500. That is what we want to determine, because in preparing our statement of cash flow, specifically when computing the cash flow from investing activities, our interest here is basically to determine, our interest is the cash which was paid. The cash which was paid is not this one. The cash which was paid is 12,600, which is the market value, minus that gain, minus increase in the market price, minus that increase in the market what? Minus that increase in the market price. Yes. Now we have that. Note number 4. Note number 5. We are told during the year which ended 31st of October 2025, our company made 1-for-5 bonus issue of ordinary shares with rising share premium. We came across this in our previous class. We said once the company make a bonus issue, there is no money which is received here. So let's first of all determine the bonus shares. How many shares were issued free of charge? So we are told the company issued 1-for-5. 1-for-5, how do we interpret that? We interpret that, or basically that means that during this bonus issue, the company was to issue 1 share for 5 shares which were held. Now, in this case, we said we need to determine the shares which were held at the start. So we go back to our balance sheet at the equity. And we take the share capital at the start. The share capital at the start was 20. I hope you can see that. But basically, these are not shares. We say divide that with the par value per share. The par value per share is what? Still in our balance sheet where we have the word ordinary share capital, the par value is 10. So meaning the shares which were held at the start, they were 2,000. So we cross multiply, then we divide. So in this case, we have 1 times the 2,000, that is, divided that with 5. And basically this will give us what? This will give us 400 shares. So the shares which were issued during the bonus issue were 400. And remember, in this case, we said during a bonus issue, the shares are issued at their par. At their par. Exactly the same thing we did in the other question. So that is these are the shares which were issued during the bonus issue. Now, meaning that this particular 400 shares, and I hope my computation is correct. So the 400 shares, which were issued at a price of 10, so the company received 4,000 shillings. So how do we account for this amount? We say that this one should be credited in the share premium account. Should be credited in the share premium account, and then we credit the ordinary share capital account. We credit what? The ordinary share capital account. That is basically the double entry for this. And therefore, we said in relation to this bonus issue, we have to prepare two accounts, the ordinary share capital account and the share premium account. So why do we have to prepare those two accounts? For us to be able to determine the shares which were issued for cash. So let's prepare those two accounts. We prepare those two accounts. And I hope you can see this question, in fact, has so many similarities with the other one which we did. Because also in that question, we had a bonus issue. There was a disposal of assets. Yes. So let's start by preparing the ordinary share capital account and then the share premium account. And I've said the reason why we are preparing this account is to determine the shares which were issued for cash. And in this case, I said whatever you record in this account is the opening balance. The opening balance, the closing balance, we record it here. The closing balance. Then this bonus share must be credited in this account, the bonus shares. The bonus shares, and we know the bonus shares at this value, 4,000. And then this account mostly will be having a balancing figure on this side, and these are the shares which were issued for cash. That is what we want to determine, which will be the balancing figure. Then we do the same. We record the opening balance in this account, the closing balance. Then these shares which were issued free of charge, the bonus shares, we are saying they should be debited in this account. So we have the bonus shares, which are the value of 4,000. And then we will have a balancing figure on this side, which now will be the cash, which was received from the shares which were issued. These shares which were issued, you'll be able to see they were issued at a premium, which will be the balancing figure here. So let's first of all start by recording the opening balance and the closing balance in the share capital. We get this from the balance sheet at the equity. From the balance sheet at the equity, the ordinary share capital at the start, this one, was 20. At the end was 40. Was 40,000, like that. Yes. So then if you balance this account, you can see the total on this side is 40. The total on the credit is 24. We have a difference of what? We have a difference of 16,000. Now, this 16,000 automatically are the shares which were issued for cash. And that is what we consider in our statement of cash flows. The same case here, we record the opening balance. We are getting this balance from our balance sheet at the equity. The opening balance here is 4,000. The closing balance here is 4,000. 4,000, 4,000. So the total on this side is 8,000. The total on this side is 4,000. So meaning that we have a balancing figure here of 4,000. And this is the share premium which was received in cash. That is what we are going to consider in preparing our statement of cash flow. That is what we will consider there. So I think we are done with that point number 5. And then I think point number 6, we are told all the sales and purchases were basically made on credit. Okay, so I don't know how that is supposed to help us, but I don't think we have any working for that. Now, what I want us to do, I want us to go back basically to point number 1, 2, and 3. There are basically a number of accounts we need to prepare there. The number of accounts we need to prepare there. the PP account and accumulated depreciation. I hope you can see, for example, with this question, like unlike the other question which we did, we are not given the depreciation for the current year. Are we given the depreciation for the current year in the additional information? No. We can only compute that by preparing the accumulated depreciation account. In this question, equally, we are not told whether there were some items of PP which were acquired. So we can only be able to do that by preparing the property, plant and equipment account, of which in this case, we'll be able to see that in terms of how we prepare this account, there will be a slight difference because the PP account here, we have to prepare it at cost. And then we prepare another account, which is called accumulated depreciation account. But I think before we do that, let's, first of all, we go to note number 2. There is something we need to compute in addition to note 2. So let's go to note 2 first of all. We are told on 1st November 2024, which is at the start of the year, the company revalued its property, of which I've said property is land and buildings, for the first time at a fair value of 24 million. Fair value is the same with the revalued amount. So if you're told assets were revalued and you're given the fair value, that is the same with the revalued amount. So 24, and actually we are told that included here is the revalued amount for land, 6 million. So meaning that buildings were revalued at 18 million. And then we are told the property had a cost of 25 million. The property, this property which was revalued, had the cost of 25 million. And we are told included in that 25 million is the cost of land. Is the cost of what? Is the cost of land. Cost of land. Cost of land. So I think maybe before we move to the other event, to the other sentence, remember, anytime the company revalue an asset, we usually have a revaluation gain, or basically a revaluation what? Loss. Anytime the company has revalued an asset, we have a revaluation gain or a revaluation what? Loss. Now, how do we compute this revaluation gain or loss? Basically, to compute this, we compare two values. We compare the revalued amount, which in other terms is the fair value. For example, in our case, we know that this property was revalued to 24 million. So we already have this. So we compare this with the net book value. With the net book value, or basically the carrying amount of the asset, which was revalued. And then in this case, we get a revaluation gain or a revaluation loss. Now, in this particular question, the examiner has not given us this. Because if you check on what you're given in note number 2, we are given the cost of the property. So are we supposed to compare this with the cost? No. We need to compare that with the net book value. And actually, we know the net book value is the cost minus accumulated depreciation. So we don't have this one. But in our case, we have this revaluation gain. So the revaluation gain, this one, we have it in the income statement. Can you go to the income statement down there? In the income statement, you are told the revaluation gain on property was this one. So can you be able to determine the revalued amount? Can you be able to determine this revalued amount? Yes. The revalued amount automatically will be the difference between these two values there. So how much is that? Is it 17 million? Is it 17 million? Because property was revalued to 24 million. We don't have the net book value, but we have the revaluation gain. The revaluation gain, which is this one. Remember, I'm saying to determine the revaluation gain, you take this one, you minus the net book value. So we have this one, we don't have this, and we have this. So how much amount do we less from 24 million to get 7 million? In this case, I'm saying should be 17. Should be what? 17. Is that the position? And Sharon, Dangote, is that the position? Then is that the position? Then is that the position? Yes. So this is the revalued amount. This is the revalued amount. At the date now, this particular asset were revalued. That was the net book value. That was the net book what? Value. But if you go back to that question, to that point number 2, that is, we are told we are given the cost. We are given the cost of this property. The cost of the property at the date of revaluation. And actually the cost here, we are told it was 25. Remember I said, once an asset has been revalued, you compare its revalued amount or the fair value with the net book value, because we know that this property comprises of land and comprises of buildings. Automatically, buildings are depreciated, but basically land are not being what? Depreciated. Yes. So included in this particular cost is the cost of land, And actually, we are told the cost of that is what? Is 5 million. Is 5 million. So mean that the difference here, which is the 20, this now will be the cost of, this will be the cost of buildings. That will be the cost of what? Of buildings. But basically, we are told at the time these assets were revalued, automatically we have said that this was their net book value. Sasa, yes. So now using this information, there is something I want us to compute. There is something I want us to compute as per note number 2. Let's go to sentence number 3 of note number 2. We are told buildings were being depreciated on a straight line basis at the rate of 2%. To what? 2%, and had a remaining useful life of that year as at the date of revaluation. So basically what that means is that before the company revalued buildings, the company was depreciating buildings, at the rate of 2%, at the rate of what? 2% per annum. This is how the buildings were being depreciated before they were revalued. Sasa, after they were revalued, we are told that now the buildings are estimated to have a useful life of 30 years. So basically what that means is that these buildings which were revalued now will be depreciated on a straight line basis, over the next 30 years. Over the next what? 30 years. So the reason why this information is important, we need to be very clear, because I know these require a lot of understanding. So for you to be able to understand what you want to do next year, you need to understand this. Before the buildings were revalued, this before the revaluation, the buildings were depreciated at the rate of 2% per annum. But after revaluation, we are told buildings are estimated now to have a useful life of 30 years. Yes. Now, why do we need to have this information? The reason why we need to have this information is because of the last sentence of that point. So we are told, however, it made an inter-reserve transfer for the excess depreciation upon revaluation. So automatically, the moment the company has revalued a building, its value increases. Its value do what? Increases. And as a result of that, you'll be able to see that the depreciation which was accounted for during the current year for the buildings is more than the previous depreciation which was computed before the buildings was revalued. So let's compute the depreciation before the revaluation, and after revaluation, you see, will the depreciation increase as a result of the buildings being revalued? So for example, before revaluation, how are the buildings depreciated? The buildings were depreciated at the rate of 2% per annum. And I hope you can see that this 2% per annum is on straight line. So if it is on straight line, it is automatically on cost. What was the cost of buildings before they were revalued? The cost of buildings before they were revalued is this one, which is 20. So if we get 2% of this, I think that one should give us, is it 400? 2% of this, 2% of that will it give us it's a 400. 400, eh? Yes, 2%, because we do away with 2 zeros, 400. So that is the depreciation before the revaluation. What about after revaluation? Remember, after revaluation, buildings now will be depreciated, used on straight line basis over the next 30 years. So what we need to do, we need to determine what was the revalued amount of buildings. Who can be able to recall the buildings were revalued to an amount of how much? Buildings were revalued to an amount of how much? Remember, the property which comprises of landed buildings was revalued to this one, 24. So tumesema 24 million, cost the revalued amount here land ni 6 million, revalued amount here building ngapi ni 18. So meaning after revaluation, we are going to compute the depreciation for buildings based on the revalued amount. The new value of the building is this. So which is basically 18, and then we are going to depreciate this in the next 30 years. In the next 30 years means to get the depreciation per annum, you take the new value, you divide that with 30 years. So this will give us what? This will give us 600. So in this case, now you can see, before the buildings were revalued, the depreciation per annum was 400. After the buildings were revalued upward, the depreciation increases to 600. Now, what is the excess depreciation? What is the excess depreciation? The excess depreciation in this case is the difference here, which is 200. You can see the depreciation increased with how much? With 200. So that is why it was important for you to understand all this. Now, having said, although in an examination setup, to keep a revision, you'll be able to see that all these workings, you don't have to do them in an exam. Basically, we are going to look on some of the shortcuts, which are basically required maybe whenever you are doing these questions, because you can see in an examination setup, you can't be able to do all this. So what I want us to do, I want us to basically move and prepare two accounts here, the PP account and basically the accumulated depreciation account. So let's prepare these two accounts here. So we start with the PP account, and this question here, we will prepare this account at costs. This account will be prepared at cost. Will be prepared at cost. Will be prepared at cost, and then we prepare this other account, the accumulated depreciation account. The reason why we're preparing this account is to compute depreciation for the year. The reason why we're preparing this account is to determine the PP which were acquired. So what do we record in the PP account? So we record the value at the start, and actually remember everything here will be recorded at cost, and then we record the cost at the end of the year. So then on this side, we record any revaluation gain. We record acquisitions. Then on this side, we record disposal. The revaluation what? The revaluation loss. Any revaluation what? Loss. Any revaluation loss? Yes. Then in this account, what do we record? We record the accumulated depreciation at the start. And then on this side, we record the depreciation for the current year, which was taken to the income statement. We record the accumulated depreciation at the end of the current year here. At the end of the current year. And also because there was an item which was disposed, the accumulated depreciation on disposal. The accumulated depreciation on disposal. So we have everything here. The opening balance, the closing balance, this one we have it. So what we want to compute is this. So in this question, we have this, we have this, we have revaluation gain. Automatically, we don't have a loss. We have the item of PP which were disposed. So what we want to determine is that. So let's start with this account, in fact. So we have the opening balances for accumulated depreciation in note 1. The accumulated depreciation in note number 1 at the start, which is the year 2024, is basically 9240. Note number 1, I'm getting that from note 1. The accumulated depreciation at the end, this one, is 10430. Then if you go to note number 3, the motor vehicle which was disposed, remember motor vehicle is part of the PP because these include property, plant and equipment. Property, plant and equipment include all tangible, non-current assets, including buildings, land, motor vehicles. All of them are part of the PP. So the motor vehicle which was disposed in note number 4, we need to record its accumulated depreciation here. So its accumulated depreciation is 800. So we get the balancing figure here, which will be what? The depreciation for the current year. Depreciation for the current year. Depreciation for the current year. So 800 plus 10430 minus 9240. So, and basically I'm getting a figure of 1990. That is what I'm getting there. Confirm whether you're getting the same. So then we need to record the costs at the start, the cost at the end, using the information we have in note number 1. So the cost of PP at the start is 33,400. Remember, I said this account we are preparing it at cost here. So the cost at the end is 47,900, like that. And then the revaluation gain. Revaluation gain, remember this one, we have it in the income statement. We have it in the income statement. Income statement. So in the income statement, revaluation gain, which is basically 700 here. Yes. And then we also have the disposal. Disposal, this one is what we have in note number 3. the motor vehicle which was disposed in note number 3, and I've said everything in that account will have to be recorded at cost. So the motor vehicle which was disposed in note number 3, we record it here at cost. We record it here at cost. Sasa, yes. So what we do, we get the balancing figure which is on the debit side, and that is the PPE which were acquired. That is the main objective of preparing that account. What do we have on the credit side? 47,900 plus 2,000 minus what we have on the debit, 33,400 minus 7,000. So in this case, I'm getting 95. 95. Confirm whether you're getting those values so that now we can be able to move and prepare a statement of cash flows. Are you getting those values? If you're getting those values, you confirm. You confirm whether you're getting those values. Yes, are you getting those values? Dagote and Sharon. Ama swali imekuwa ngumu. Yes, I know this question is a challenging one, but it's a very good question. If you understand it, it's a very good question. It's a very good question on the statement of cash flows. It's a very good question. Juma, are you getting that? Are you getting those values? Are you getting those values? Are you getting those values? I will presume yes. Yes. So I think now we can be able to move and we prepare our statement of cash flows. But even before we look on we prepare the statement of cash flows, someone may ask, how is this excess depreciation accounted for? This excess depreciation. Now, this excess depreciation, the double entry for this is usually debited in the account which is called the retained earnings. Is it the retained earnings? No. This one, in other terms, let me put it like this instead of giving a double entry. This one, excess depreciation, this is deducted from the revaluation gain. You see, the reason why there was excess depreciation is because the assets were revalued upward. So this one is basically deducted from the revaluation gain. If, for example, you go to a balance sheet, to a statement for financial position under equity, can you go to the statement for financial position under equity? Under equity, can you see we have something called the revaluation reserve? Under equity, can you see something called the revaluation reserve? The revaluation reserve is an amount of how much? Jane? Revaluation reserve, which is under equity. You can be able to see the revaluation reserve, it is 68. But, and actually you can see at the start it was 0. So what we know is that revaluation reserve basically arises from this revaluation gain. Can you remember the revaluation gain? The revaluation gain was 700. But I hope you can see the amount which was transferred to the revaluation reserve account is 68 instead of this one. So now this excess depreciation number 1 is deducted from this. That's why you can see the amount taken to the revaluation reserve is 68. So this one is deducted from this revaluation gain. And then number 2, it is added to the retained earnings. It is added to the retained what? Earnings. And therefore, when computing the dividends, remember the other question we did, we were computing the dividends paid using the retained earnings. So when computing the dividends paid using the retained earnings, we must remember to capture this. So to touch retained earnings at the start of the year, and then we will add this amount of 200. Sasa, yes, because this excess depreciation is how it is accounted for. It is deducted from this revaluation gain. It is then added to the retained earnings. Sasa, yes. So when computing the dividend paid, lazima tukumbuke hiyo amount ya 200 to add it to the retained earnings at the start. Sasa, yes. So having that, let's move and prepare a statement of cash flows as required by the examiner. So the name of the company is 𝐕𝐎𝐈𝐍 Limited. And basically this is a statement of cash flows. A statement of cash flows, which is for the year, which ended 31st of October 2025. A very good question on cash flows. Very, very good question on cash flows. Yes, so remember here we said we start by determining the cash flows from operating activities. from operating activities. We need to have two columns here. And basically our figures are in thousands of shillings. Our figures are in thousands of shillings. Are in thousands of shillings like that. So when computing this, we said always start with the profit before tax. Not before tax. Yes, the profit before tax. Always the profit before tax is an amount of 2880. 2880. Remember, we get this from the income statement, profit before tax, and then we make a number of adjustment to this profit. We make a number of adjustment to this profit, and we say the first adjustment to be made to this profit should be to add back the finance cost, such that we have the profit before interest and tax. So the finance cost is just above that profit. I hope you can see it somewhere. Can you see that profit somewhere, Ben? Vanessa, can you be able to see that profit somewhere? Not profit, rather. Can you be able to see that finance cost somewhere in the income statement? Can you be able to see that? Jacqueline, can you be able to see that finance cost? Yes, it is 1,000. It is 1,000. So basically, after adding it, we have now the profit before interest and tax. Then from there, we said we need to make a number of adjustments to this profit. And actually, we said, first of all, we adjust our profit with the non-cash items. So we said just recall that acronym, dial G. So this one stands for depreciation. Depreciation on what? Property, plant and equipment. This one stands for impairment loss. Impairment loss on goodwill. So actually in this question, we don't have this. This one stands for amortization of intangible assets. Equally in this question, if you check on what we have under the non-current assets, under the non-current asset in our balance sheet, we don't have intangible assets. Equally, we don't have this. This one stands for loss on disposal. Do we have the loss on disposal? Yes. Working 2. We have a loss on disposal of 180. We record it here. And remember, you said that these 4 items should be added, but the gain should be deducted. So then this stands for gain on disposal. Do we have a gain on disposal? No. So we don't have this. We have this. We don't have amortization. We don't have impairment loss, but we have depreciation. Depreciation is what we have computed here, this one. 1990. 19 what? 1990. So that's basically what we have. Then in this income statement, can you go to the income statement which we have? In the income statement, just above this profit, there is something called investment income. Now, this investment income, we are told there are dividends which were received. Automatically, these dividends which were received, I hope you can be able to recall our company has invested in shares. This investment in shares. So the company, as a result of having invested in shares, it is receiving some dividends. Now, this dividends or this investment income, we said this one is not an income from operating activities. This one is an income generated by the company from where? From investing. So take into account that income is already included here. We need to deduct it. We need to deduct it, investment income. Why are we deducting it? Is because this is not an income generated by the company from what? From operation. It is an income generated by the company from what? From investment. So this one will be considered when computing the cash flow from investing activities. Remember, these are dividends received. These are dividends received. We list them here. Yes. And I think we get the net amount. So that then we proceed and we make the adjustment for changes in working capital. So let's get the net amount. So we will take 2880 plus 1,000 plus 1990 plus 180 minus 150, and I'm getting 5,900. I'm getting 5,900. I'm getting 5,900. 5,900. I'm getting 5,900. Is that what you're getting? 5,900. Are you getting 5,900 there? Are you getting 5,900? Dagote, are you getting 5,900? Yes. So then next we need to consider what? Next we need to consider something called the changes in working capital. Next, we consider changes in what? Changes in working capital. And basically, we said that if you come across a question for cash flow, make sure you get these marks. Because here we said you just consider three items. You just need to record that acronym. RIP, not less in P's, but receivables, inventory, and payables. So receivables, inventory, and who? And payables. Then this formula here, opening minus closing, opening minus closing, and then closing minus opening. As simple as that. Now, let's go to where we have current assets. In our statement of financial position, we consider, first of all, the receivables. The receivables, you take the opening balance. Opening balance is the value we have in 2024. Closing balance is the value we have in 2025. Receivables at the start is 5590 minus the closing, which is basically 65, which will give us negative 910. Write it there as a negative, is a cash outflow. We do the same for inventory, still at the current assets. So opening inventory, which is 6880, minus closing, which is basically 9580. We have negative 27, which is still a cash outflow. I hope you're getting those values. And then we go to where we have current liabilities. Current liabilities, we consider the payables. Payables, we use that formula, closing minus opening. Closing is 3640 minus opening, which is 31. And basically, I'm getting positive 540. So you can see these marks are quite free, or these are basically free marks. And that's why I said, if you happen to come across a question for cash flow, make sure you get those marks there. Make sure you get those marks there. So having that, I think we can get the net amount 59 minus 910 minus 2700 plus 540. So that will give us 2830, 2830, 2830, 2830. I need to create some space here. So I will do away with this. So I hope you already have this. So the bonus issue here was the bonus issue, not the bonus issue share premium, 4,000, and the shares which were issued for cash, 16,000. So that's basically what we need to have from these two accounts here. So I need to do away with this. Yes, so in that case, we are getting a net amount there of what? A net amount there of 2830. And then to this, we said we less two items. Number one, we less the interest or finance cost which was paid, interest or finance cost paid, and also we less tax paid. I think we can start by computing this one. For the interest paid, we said we check two items. The interest or the finance cost from the income statement, this one, which is 1,000, and then you go back to your balance sheet, specifically under the current liabilities. Current liabilities, you check whether there is any accrued interest. Do we have any accrued interest under the current liabilities? Do we have any accrued interest? Automatically, no. Ama tuko nayo, Dagote? Do we have any accrued interest under the current liabilities? No, we don't have any. So, but in this case, we said if there was any accrued interest, what you do, take the accrued interest at the start, or the interest payable at the start, which we don't have, plus the finance cost in the income statement, which is this one, 1,000, which is basically 1,000 minus the accrued interest at the end. So the difference, or basically whatever you get, is the interest which was paid. We do the same for tax, but we say for tax, usually in the balance sheet, we have two components of taxes. Under the non-current liabilities, under the current liabilities. So under the non-current liabilities, we have deferred tax. These are taxes to be paid by the company in the future. And the current tax under the current liabilities, these are tax to be paid within the next 1 year. So how do we compute that? We say the approach is the same. Though here now we have two components of taxes in our balance sheet. So we take, first of all, can we go to where we have non-current liabilities? And I want you to understand this because you'll come across this in all questions for for cash flow. So the deferred tax at the start is 960. So at the start, and then to this we also add the current tax at the start, and the current liabilities. And the current liabilities, the tax which are not being paid before 90. So then to this, just like what you have done for the interest, we take the tax from the income statement. The tax from the income statement, you can be able to see the tax for the current year. From the income statement, the tax for the current year, the tax for the current year, the tax for the current year, we can be able to see that is an amount of 940 from the income statement. Then to these, we less the taxes which are not being paid at the end. First of all, we go to where we have non-current liabilities. The deferred tax at the end was 880, and under the current liabilities, the current tax not yet paid was 620. That is how we compute the tax paid, and we use the same approach even in the other question. Even in the other question, we compute the tax paid. So we have 960 plus 490 plus 940 minus 880 minus 620. So this basically will give us what? 890. 890. So basically this is what? This is the tax which was paid. So having that, we move, and basically we get the net cash flows from operating activities. Net cash flows from what? Operating activity. So we need to work out that. So we have 2830 minus 1000 minus 890. So basically this one will give us what? Will give us 940. The net cash flow from what? From operating activity. So next, we determine the net cash flow from investing activities, or basically we determine the cash flow from investing activities, cash flows from investing activities, Now, what do we consider here? Number one, asset which were acquired. Number two, asset which was disposed or sold. And number three, any income generated from investment. That is basically what we consider here. And I think we have everything which is required here. I think we can start with this investment income in the income statement. This we said is an income generated from investing activities. So we have investment income, which is basically an amount of 150. And this one here it is considered as an inflow. Remember, this money which was received by the company from investing. So these are cash received from investing. So what else do we consider here? In note number 3, there was disposal of motor vehicle. Note number 3, and remember in this case we said what we consider here is the sales profit. How much amount was received from selling that motor vehicle? As per note number 3, it was 1020. This 1020 is still a cash inflow. Is still what? A cash inflow. Now, still, as per the information we have in note number 4, we have this investment in equity instrument which was acquired. In other terms, we have these shares which were bought by the company during the current year. So we talk about investment in equity instrument, So these are shares which were acquired. This is an investing activity. So we consider the cash which was paid, this one, which is 11,500. And this one is a cash outflow. Being a cash outflow, recorded there as a negative. Then from this account which you have prepared there, the PP account, we have determined that there were some PP which were acquired at a cost of 95. So we have PP which were acquired. PP which were acquired at a cost of 95. At a cost of 95. I don't think we have anything else here. So basically what we need to do is we determine the net cash flow from investing activities. Net cash flow from investing activities. So we have 150 plus 1020 minus 11,500 minus 95. So the net cash flow from investing activities is 19,830. 19,830. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. So then next, we determine the net cash flow from financing activities. Recall, we say that all the items which we record here, we basically get them from equity and the non-current liability section. So you just go to your balance sheet, your statement of financial position, at the equity and also at the non-current liabilities. That is basically where you get the items to be included here. Where you get the items to be included there. Can we do that? Can we do that? So we start with the equity section. At the equity, the first item, actually the first two items, we have done some workings for that. Ordinary share capital, share premium. So we have said what we consider here are the shares which were issued for cash and the share premium which was received in cash. And I think we have already computed that from the two accounts we had prepared here, the share capital and the share premium. So we will say there was issue of ordinary shares. And basically we consider the shares which were issued for cash. And I think from our share capital account, 16,000. 16,000. So these are shares issued for cash. We consider that here. And then we also consider the increase in share premium. So the amount of share premium which was received in cash, which is from the share premium account, 4,000. Forward, 4,000, 4,000. So basically, from at the equity, I think we have dealt with those with those two items. With those two items, then below share premium, we have revaluation reserve. Revaluation reserve, do we consider that here? No. We say that arises from the revaluation of assets. Revaluation gain is a non-cash item. We don't consider that here. Below that, we have financial asset reserves. Financial asset reserves, equally, we have said, it is the increase in the market value of these shares. This one is also a revaluation gain. A revaluation gain is still a non-cash item. Don't consider that here. Once the market value of an investment increases, no cash which is received from that is a non-cash item. Don't consider that here. So then from there, we have the retained earnings. Remember these retained earnings, we use it in computing what? The dividends paid. And I think I gave you a formula for computing this. We said we take the retained earnings at the start plus profit after tax minus the retained earnings at the end. That is the formula. But in this case, we have said that there was an excess depreciation. That excess depreciation of 200, I hope you can remember that. We have said it should be added to the retained earnings at the start. Because we have said that excess depreciation should be deducted from the revaluation gain. This one, the revaluation gain we had of 7,000 and then added to the retained earnings. So therefore, let's compute the dividends which were paid. I will take the retained earnings at the start, which is at the equity, which is basically 20,350. Even before I add this, I must add the 200, excess depreciation. Excess what? Depreciation. And then I add the profit after tax. The profit after tax, I get this from the income statement. From the income statement up there, the profit after tax is the same with the profit for the year. 1940. And then minus the retained earnings at the end, which is basically 40/40. Which is what? 40/40. Yes, so you can see this one was a little bit tricky because of this concept of excess what? Depreciation. You needed to compute that. So 2350 plus the 200 plus the 1940 minus 40/40. So basically, I'm getting dividends paid off for 50. Remember, dividends paid is a cash outflow. So record this as a negative. So we are done with all items of equity. Sasa, we got to non-current liabilities. Non-current liabilities, how many items do we have there? 2. So we are only considering 1 because deferred tax is used in the computation of this. So we are only considering 12.5% loan notes. And those 12.5% loan notes, you can see we have an increase in their value. So what causes the value for this 12.5% loan note to increase? Their value increases because the company issued additional 12.5% loan notes. So if the company issued loan notes, the company receives some cash. So here we will say there was issue of 12.5% loan notes. So which is equal to the increase. So how much is that increase? Is it 800? Is the increase 800? The increase, is it 800? Is the increase 800? Increase in 12.5% loan notes. At the start 76, at the end 84. Yes, we have an increase of 800. So that is caused by issue. That's that? Yes. So we have done. We have done. So what we need to do is to get the net cash flow from financing. So we have 16,000 plus 4,000 minus 450 plus 800. So this gives us 20,350. And then now from there we get the net changes in cash and cash equivalents. How do we get that? We said we need to add 3 cash flows. We need to add the cash flow, the net cash flow from operating, the net cash flow from investing, and the net cash flow from financing. Sasa, these 3 cash flows, this, that, and that. So let's add that. We have 940 minus 19,830 plus 20,350. And basically that will give us what? 1460. 14 what? 60. Then to this, what do we add? We add the cash and cash equivalents at the start. The cash and cash equivalent at the start. So this cash and cash equivalent at the start, we have it in our balance sheet at the current assets. So how much is the cash and cash equivalent at the start? Cash and cash equivalent at the start. Who can see that? Yes, the cash and cash equivalent at the start is 18 what? Is 1870. So after adding the 2, we should get the cash and cash equivalent at the end. The cash and cash equivalent at the end. The cash and cash equivalent at the end. Cash and cash equivalent at the end. And how much is that? That one is basically how much? That is plus 1870. And basically that will give us what? That one will give us 33. That. So this 33 that we said, it should always reconcile with the value we have in our statement of financial position. Are the 2 values reconciling? Are the 2 values the same? 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 Yes, the 2 values are the same. The 2 values are the same. So it basically means that we are 100% correct.
amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting, it's determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you are supposed to compare the two. You cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. an amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine. Let's proceed. So we now looking at future value of a lump sum. Future value of this kind of cash flows. Future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what we call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, that there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is OR. So here you say OR, a very long method. You'll say period here, period 1, 2, and 3. Amount, let's say 100,000. No, will that give us? No. No, that is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times, so we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout, okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%, the investment will earn interest at a rate of 20% compounded annually. The investment will earn interest at a rate of 20% compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shillings 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. At the end of each period. 60. At the end of each period, this person is investing 60. So here you say 1 plus r power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus r. 1 plus r. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, That is what we've done in part B. But now we have what we call okay, fine, Alice. 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year. At the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that